All right, thank you very much. As Kelly just mentioned, so Matt and I have been working with a number of customers kind of on the front end during the sales process as they're going through software evaluation, and then more recently, kind of working their way through the adoption process. So structuring this session around some of the things that we're seeing across the board, beginning with policy on the front end, so not necessarily CoStar software specific, things that might impact the implementation or some of the configuration decisions within the application. Things that we're seeing on the data front from a collection standpoint, some of that overlaps with what Matt talked about in the previous session. And then going into the system setup just a bit. So some of the things, kind of helpful, tips and tricks, if you will, taking some of that data collection and policy decisioning and how that informs the system setup. And then from there, ongoing process. A combination of how we're seeing companies structure their lease management and lease accounting teams. And then some of the things that are going to be required from month-end close reconciliation standpoint that ASC 842 is introducing that are not done today based on the current accounting standard. Some of the things that we're hearing in that regard and a little bit more of the day two process. So less focused on the data collection and initial implementation and more about how clients are going to operate their lease portfolios going forward. The first thing I'm going to let Matt start off with is some of the accounting policy related decisions that we're seeing. We'd like to get some of your takes on those as well. And one, things that will help speed up some of the implementation that FASB and IFRS have offered. And again, just kind of in the market, what some of those companies are dealing with. So Matt?
Thanks, Mark. So the first slide here, absolutely, practical expedients are your friend. I mean, we have dealt with hundreds of clients now, and almost everybody is taking full advantage of the practical expedients. Really, the most recent change in that arena was the look-back period. So when we first got the standards, we were thinking that we were going to have to make our accounting effective 1/1/17 to be able to adopt as of 1/1/19 and present comparative financial statements. FASB decided to relax that requirement, so now we can just go forward from 1/1/19 and then present our comparatives under ASC 840. And a few people, maybe the less than a handful of early adopters, maybe they are using the look-back period, and a couple of people who had some compelling reason, or maybe they were far ahead of the game. But by and large, I'd say 95, 99% of clients I talk with were delighted not to have to present those 2 years. The retest, practical expedient, so basically that just means if you had a capital lease under the old standard, it rolls right into a finance lease treatment. If you had an operating lease, it rolls into operating lease treatment. I don't have anybody saying, "Oh yeah, we're just dying to retest all of our leases," right? The only caveat I'd say is that FASB certainly did not intend to grandfather in any kind of errors. So if you just had a big group of leases that had been overlooked in the past, of course you do need to consider if they were capital leases or if they should have been capital leases. You might want to think about a true up there, but by and large, most of those items are equipment leases and would have been operating anyway. Okay, short-term leases. Now this is specifically called out in the FASB's document, ASC 842. It's 12 months. So you have the option to not include leases of a term greater than or less than 12 months on your balance sheet. But that does include the reasonably certain assessment. So if it has options associated, and you can honestly say, hey, no, this is truly short term, less than a year, you can exclude that. Although you still need to track it and report it as part of your disclosures as lease cost, just not part of your right of use asset lease liability. Now this last point on this slide. Basically the materiality of the right of use asset, lease liability, the threshold. IFRS called out a dollar amount, and it's $5,000. So a lot of companies that are international, of course, are using that threshold. is explicitly called out. Now, FASB did not call out a number, and you have to actually dig pretty deep to find any guidance at all from FASB. But if you look in the basis for conclusions for ASC 42, you will find a paragraph that talks about the low-value leases, basically. And the wording is something to the extent of we expect companies will apply reasonable materiality thresholds, and one approach could be similar to your fixed asset capitalization policy or threshold. So, you know, a lot of companies, though, haven't updated their fixed asset threshold in 20 years, and it's sitting at like $250 or something, so that might not help you out. I will say I've seen this all over the board. You know, some people going with 5,000 because it matches up with IFRS and they have dual reporting requirements. Some people going with their fixed asset threshold. Some people making arguments for very high, like in the $1 million range for materiality for right-of-use assets, lease liabilities. And particularly in that last scenario, I'd say definitely document that and show it to your auditors before you show up, you know, Q1 and say, hey, we've got 5 leases. You know, just something. Again, I recommend that for every accounting policy that you're setting now that relates to the new standard. Write it up, run it through your internal process first, review process, and then ask your auditors to give their blessing. All right.
It is interesting, you know, people that kind of got started early on this adoption process, either much earlier in the year, even last year, some of the decisions that they're making around these practical expedients, you know, inventorying their entire lease population, getting those things on. We're still getting RFPs for calendar year-end companies for people that haven't moved yet and haven't even made a software decision and are still in the process of gathering leases. It's amazing how their decisions around some of these practical expedients change. Yeah, we're going to lump in lease and non-lease components together and not really, you know, care about the balance sheet gross up, or you know, not worrying about the short-term leases in terms of inventorying and just grabbing them separately from the GL. We'll talk about that a little bit further on an ongoing basis also. The data collection process, some of this ties into the discussion that we just talked about, right? And especially the clients that are still kind of racing towards compliance from a data capture and software standpoint, really just focusing on what I'll call the financial abstract, or the date structure, the cash flows, some of the option decisions, and then obviously things like discount rate and whatnot that are going to factor into the balance sheet impact. So kind of ignoring in this initial phase some of the more operational data elements around that lease administration activity, especially on the equipment side if they've, you know, not had a system in place before. So really just focusing on some of those critical elements and you know, making sure that they're capturing the material items that will support the calculation and ultimate impact. And then circling back, you know, next year, if you will, at a point to be determined in order to gather some of the you know, additional data from there. Matt touched on it in the last session, but being able to source some reporting through the GL or AP to identify lease costs, largely around equipment and embedded leases, to be able to make sure that they have the appropriate inventory there from a data capture standpoint. So certainly something in addition to the surveying that Matt talked about that we're seeing across the board. There's a number of tool sets that are available in part of the software that we're offering to take that data once it's sourced and get that into the application. So with that ETL nomenclature that we'll talk about a little bit further on in the product session you know, later, really just trying to speed the data entry process or the data upkeep process, to not have to worry about going into the UI on a granular basis and maintain some of that detail. And then I have another one there around the, you know, ignoring short-term leases. This falls into largely a disclosure discussion around how you're going to source some of the information for disclosure reporting. So there's some call-outs for short-term leases and reporting exceptions, you know, sublease income, a few items like that, where they're going to be required as part of that new quantitative disclosure, but some clients are making the decision to not go through the effort on upfront in order to load those. So identification through a GL account on the balance sheet, being able to extract that via a separate report and consolidate in the financial statement, cuts down some of the time on the front end to be able to source that information, have to populate it in CoStar, and then kind of going through the effort to tie that out. So in terms of a time-saving step, that's certainly something that that some of our clients are focusing on and that we're seeing. Anything else on the data collection topic, Matt, that you can think of that we've talked to clients about?
Yeah, I'd say that last one, ignore short-term leases, low-value leases. Now that means ignore for right-of-use asset lease liability, but definitely keep in mind there are still disclosure requirements around those, around reporting cost. So you do want to track them in some way.
So in terms of the system setup, so again, some of you are ahead of the game here, I would say, meaning having the technology in place for a while. Some are kind of mid implementation effort for the lease accounting side. I touched on it in terms of data collection, but that initial compliance phase is obviously something that's going to be critical from here through end of year and into Q1 as we look to source some of the data from a calculation standpoint for budgeting or for audit committee. Moving into to the next year. So, migrating that data we talked about a bit, the system setup, issues and items to focus on in terms of, how we're going to export to the GL and impact the balance sheet. What some of that, I'll call it standard automation might look like to, bring in currency or FX into the system. Really focusing on those critical path items initially, in order to get the system stood up, if you will. A lot of clients are following that on with rounding out the data collection effort, so kind of proving that the system and the technology work. From there, if they're confident that it's supporting the appropriate calculations, supporting the reporting that's going to be required, both from a disclosure standpoint and extraction to GL, then they're moving forward with that full population from an equipment standpoint. That tends to be that inventory that's kind of gathered either, as Matt mentioned, across the lessors that clients are working with, or sourced kind of disparately from various groups. Either regionally or across multiple business units. And then a following on phase for more full system automation on an ongoing basis. So again, after we've inventoried, after we're comfortable from a disclosure standpoint, after we understand what that balance sheet impact looks like, then going forward and then automating, whether that's the push and pull of data to and from CoStar to different systems that might exist, lessor systems, as Matt mentioned, if we're going to pull in things from fleet vendors, ServiceNow or other types of IT softwares, that's certainly what we're seeing there. That first bucket that we talked about, that critical path item, so the migration of leases, we've hit on that from a data standpoint, making sure that the monthly push to the GL is functioning appropriately, right? So I'm not going to get into the CoStar speaks in too much detail here, but making sure that we have appropriate definition around those balance sheet accounts. We're structuring the journal entries in the appropriate format. That may not always mean automation or direct connection with GL, but certainly in most cases would mean at least an extraction in some type of Excel file or report that's going to get you those monthly entries on an ongoing basis. And then that also with that push would require monthly or perhaps discount rate updates on some cadence, whatever you've put in place. Some clients monthly, quarterly, et cetera, to maintain that on a go-forward basis. More of that day two effort that would be required for future calculation, and then the FX push into CoStar that would be required for any of you that have leases denominated in currencies outside of USD. Making sure that we're calculating the disclosure appropriately. So we'll touch on the reporting in just a second, or the peer reports, but obviously that liability and right-of-use asset impact as being a component there, as with that breakout between operating and finance leases, a main component of that disclosure report. The variable cost detail, so not necessarily rolling into the right-of-use asset calculation. A number of you have that already in the real estate leases. That would be CAM and tax and other things, not necessarily factored into that base rent expense. That would be a source for that disclosure reporting. And then sublease income as well, probably mainly around the real estate portfolio, but if you happen to be subleasing any equipment or the lessor on the equipment side, that might factor in as well. So those core items that would be needed. CoStar is going to help you with some of the weighted average rates and the new quantitative disclosures that are going to be required, obviously dependent on that data. And then pretty similar to what we're doing today, there is that 5-year future cash flows component in the disclosure that will still be needed on a go-forward basis. Matt, in terms of critical path for compliance, obviously as clients are looking to year end, you mentioned audit committee in the last session. Can you talk a little bit about what some clients are looking for as part of that reporting to audit, and in some cases you've mentioned SAB 74 in prior sessions as well?
Sure. Yeah, a critical path I think is a great way of putting it, because it's so tempting when you implement a system like CoStar that has robust capabilities. It's tempting to just go all in, right? You know, get everything configured, and we're going to make our life so much easier. We'll close the books in 3 days, right? But in-state CoStar does have all of that capability that you will get benefit of long term. But right now, where we're sitting, it is more of a critical path. You want to comply with accounting standards, and I think this is a nice list for that. SAB 74 at this point, you're required to talk about the impact of future accounting standards that you're going to adopt in the future after they've been pronounced. So I think at this point you probably already have a process for SAB 74, but the intent, my understanding is that the SEC has said, as you get closer to the due date or the adoption date of the new standard, your disclosures under SAB 74 get more and more robust and more quantitative, right? So 2 years ago, companies were saying, hey, there's a new leasing standard, we're looking into it, it's probably going to be material. I know I paraphrase, but now a lot of companies are putting in some numbers in their SAB 74 disclosure. I'm not saying everybody has to, but it's just something to consider. Then, one thing on here is the weighted average calculation, and I say that the whole disclosure report I think is definitely something that's critical. But just think about how tedious it would be to calculate weighted average interest rates and lease terms across your entire lease portfolio in Excel. We're talking about a arduous task. You'd probably run a few staff accountants out of the company if you tried to do that. So that's, honestly, that's why there's such value in a system like CoStar, and so that is on the critical path, getting those disclosure details produced. I think one thing that could be flexible on here is the monthly push to the GL. Now, you have to have the numbers, you have to have the amortization tables so that you can produce journal entries. If you do get in a really tight spot, timing-wise, you could save some time by not integrating directly with your GL to start with. We have some clients taking that as a strategy. They're going to use the reports generated from CoStar and then upload those into their ERP system. It could save you some time if you get in a pinch.
Two more things on reporting before we move forward on the business process side. So Matt, a number of clients are saying we need a number to present to audit committee in fourth quarter by, say, mid-November as an example. Can you talk a little bit about what they're actually trying to produce, kind of that level of granularity? Is it just top level right of use asset and liability, or by company, internally within the organization? So can you talk a little bit about the information that they're trying to source and present to audit committee in some cases?
Yeah, I think a lot of times the questions that are coming from the audit committee are really focused more on the impact overall, right? What's the total right of use asset, lease liability, and they're looking at things like the ratios that are going to be impacted, right? I think certainly it's going to vary by each and every company, but in my experience, the questions from the audit committee are pretty top level. Impact and how does this affect the strategy of the company, and then on a different tone that you'll hear about from the audit committee will be, well, where are we in the project? Okay, you've given me an estimate of these numbers, but how close are we to actually tying that out, and are we going to have a system in place? And talk to me a little bit about the controls that you have in place right now. So they're assessing what's the impact on one side. They're assessing what's the risk, to our organization on the other side, because the consequences are pretty dire if you don't comply with the standard, and so they're making they're going to make an assessment about how maybe other resources that might need to be called in, or what's their backup plan.
And then last question here before we move on. So, obviously everyone, if let's say their calendar year end or December year end is focused on 1/1/19, right, as a kind of a drop dead date. But from an overall financial reporting and disclosure standpoint, can you talk about kind of what that truly means for somebody that might be a December year end in terms of timing of some of those disclosure activities or reporting that they're going to need?
Absolutely, yeah. Yeah, as we get really close to 1/1/19, we're having more and more discussions about, okay, well, do we really have to be done by then? We released the Q, right? And we need to have that pretty much done in April, right? So what's our real deadline? And I'll just say, ideally, there's no doubt the best practice for a company with thousands of leases or even hundreds of leases is to have is to have an amortization table for every lease on 1/1/19 and just start booking entries based on the amortization table. Now, a reasonable strategy, if you are behind, would also be to get those done in the first quarter, get your amortization tables done in the first quarter, and be ready to present the numbers on your Q. Again, not the best practice and not going to be sustainable going forward. You will have accountants pulling their hair out, right, trying to prepare that every time because it's just such a more detailed process now than it used to be. However, if you do get behind, I think I'd suggest maybe have your portfolio that you're far enough along with, maybe your real estate portfolio, go ahead and get that running. And if you have to delay something, just delay one bucket, and then maybe you can get that done in the first quarter. But again, the best thing to do is to get everything done by 1/1/19.
All right, thanks, Matt. So we'll finish up with a discussion a little bit about process. So more on the day two side. So how we're seeing some clients again structure the management and accounting of leases, and how they're thinking about it from just a general structure of teams point of view, and then going forward how that might impact the CoStar setup. This will follow on into some of the things that Michael Murray Hobbs will talk about in the following session. So on the client side, obviously the difference depending on how they're structured between a centralized or decentralized group could be geography or business unit or asset class. For both the management of leases as they come into the portfolio. In some cases, clients have dedicated lease administration teams from a real estate standpoint that are taking leases once executed or amended, and then loading them into CoStar, right? Getting the appropriate elements abstracted into the technology. Less common on the equipment side, that just hasn't been a discipline, typically from a risk management standpoint, or hasn't been as important for our clients on the equipment side. So understanding, who is going to be responsible for that activity. Again, is that a centralized team? We're seeing some clients structure a lease accounting shared services center across the board, and maybe that's for one team individually within the company. In some cases, regionally spread out for somebody that might be operating on a global basis, where all leases once executed are routed to that team and then ultimately entered into the lease accounting software from a data entry point of view. Separately, we have operational users versus accounting users. So regardless of how that data is getting into CoStar, being able to structure the software to allow for different types of what we call security groups or roles to be able to, from a controlled point of view, do the data entry around the cash flows and around the dates versus apply the accounting assumptions and ultimately generate the accounting schedules off of that same data. So there's a number of different workflows that are going to help with that. One, alerting when new leases come in or when remeasurement is required. And then two, being able to differentiate or segregate access in the system to provide that level of control that's going to be required and that Matt mentioned. And then within that, so not just the operational versus accounting teams, but more a preparer and reviewer role that you guys have right now for payables or for the way that the journal entries are processed into the GL today, making sure that's structured within the application as well, and making sure the appropriate people are have the right types of system access, and that's auditable on a go-forward basis. So in some cases, we're, again, depending on the geography or in some cases the business unit structure of the client, seeing this in a number of different ways in terms of how that's done. Internal process across departments. So Matt talked a little bit about the procurement activity. we're seeing a number of clients kind of introduce into their procurement event a lease check. So if they have something like an Ariba or technology in place that manages that procurement activity, that's becoming part of that data entry or input exercise. So does this procurement event trigger a lease, or is this going to result in the creation of a lease? And then that triggering a downstream delivery of information to the accounting team or whoever's ultimately going to be responsible for the entry point of that lease. In some clients that don't have that centralized procurement activity or that centralized procurement software, they're relying on more of a local control effort by either somebody at the country level or business unit level that's going to be responsible for the identification and maintenance of those leases in that day two world. Meaning they might just be responsible for populating an Excel template or an ETL template when new leases come in or when there's a change. In some cases, they're security controlled to just see their leases that exist within their component of the portfolio, and that responsibility for that management and accounting goes down to that local level. So those are, again, some implementation decisions that affect both the setup of the software and then what that operation looks like on an ongoing basis. And then standardizing outputs for GL. Matt talked about this previously. Not necessarily connecting directly with SAP or Oracle or whatever your ERP system happens to be, but at least being able to push out a standard file across the company that you might present down to somebody at the local level for translation and then push back into the GL at their local level. Especially companies operating in a multiple or disparate ERP environment, seeing this approach taken in many of those cases. Matt, either on the structure of teams or some of these control points, anything else to piggyback on there?
I'd say I think the lists we talked about in the last session, list can be a big help because it's so easy just to go down a path and then wonder if you covered off everything. So again, use the resources on the CoStar Real Estate Manager website. Use the Big Four guides. I can tell you they are extensive. I think 700 pages is the longest one, but they're all quite lengthy and have a ton of great information in them, including lists and decision trees and things like that. So I encourage you to use those resources just to check off, make sure you're thinking of everything in regards to this.
I'm going to talk a little bit about a day two reconciliation problem, and then Matt's going to go through some of the solutions that we're seeing. But this is involving cash paid for leases, either from CoStar or otherwise, versus the balance sheet entry that most likely will be coming from CoStar, and that reconciliation that's going to be required. So for some of you, you're already integrated, let's say for your North American real estate, integrated with CoStar from a payable standpoint, going through an approval process, pushing that rent file from CoStar to AP, getting checks cut, et cetera. That's the top section here. For that component, no real reconciliation required, right? CoStar is the system of record for that payable entry, will be the system of record for that GL push. Those, in a perfect world, are going to equal, and then no reconciliation required. In practice, real estate outside of North America, and certainly equipment for most of you, not paid directly in CoStar, meaning invoiced and paid locally by the business unit, by the country, if it may be international. And in that case, there is no automated push from CoStar for that payable activity. We're still going to have that cash entry though on the balance sheet or on that output of the GL file on a monthly basis, and that exercise is going to result in a reconciliation process you're going to have to put in place, right? Something that doesn't exist today, and something that a number of our clients are wrestling with as they implement CoStar for the lease accounting side, because this isn't a problem that they had to worry about, not a problem that they worry about today, and how's this going to get taken care of on a go-forward basis. So Matt, we've seen a couple approaches out there. You want to go through the clearing account approach first, and then we'll talk a little bit about something more automated after
Sure. That. Yeah. So usually when I talk about this, I'll use T accounts. So who loves T accounts? Raise your hand. All right. But really, I'll talk through it. If you need to see it in T accounts, email me and I'll send you a spreadsheet. But basically, there's two sides of this process, as Mark talked about. There's the AP side, or the payment of rent, and then there's the lease accounting side. In CoStar, you'll see that reflected in the lease abstract, which drives the actual payments if you integrate. And then, so what you're left with there, you have a credit that goes somewhere, ultimately credit cash and debit something. If you were on the cash basis of accounting, you would just debit expense, okay? So that you're sitting there with a debit. Then a different side of the system takes all of your scheduled payments and then produces these amortization tables that are so key to this process. So that's what gives you your present value of your future payments, sets up that lease liability. It gives you the right of use asset. And then as those items start amortizing down, every line on that amortization table ties out and can create balanced journal entries, standalone. And one of the columns in that schedule is the payment column. And a lot of times folks look at that for the first time and say, oh, that's where my cash entry is coming from. And it's not. That amortization table will never send cash out the door. It's only to take that debit that was already sitting from where you paid your rent and credit it out and then flow everything through to the proper accounts based on lease accounting rules. So ultimately you end up with a credit to, if you used rent expense, credit to rent expense, then you'll get another debit back into rent expense for an operating lease, but it'll be the level expense amount or the straight line amount. For a capital lease, rent expense will be zero, or a finance lease, rent expense will be zero, and you'll end up with interest and depreciation expense from that process. And Mark mentioned the use of a clearing account, and that's just because really when you send out that payment through AP, you can hit any account you want. You're not limited to rent expense. So a lot of companies are deciding, well, we don't want all that noise. The example I just talked through, there was a debit to rent expense, a credit to rent expense, another debit for a different amount to rent expense. They say, oh, we don't want all that on our operators' P&Ls because they'll just flip out. When they see that activity, we just want one number hitting rent expense every month, the straight line amount. We want to use a clearing account for the in and out that happens due to the difference between cash rent and straight line rent or level expense. So the clearing account is a very real strategy that's used all the time now.
The other thing that we're trying to solve for in more of an automated approach is working with Blackline, account reconciliation software. A number of you guys are familiar with, have implemented, or have in the budget to implement their account reconciliation module. So we've been working with their product team in earnest over the past 6 or 7 months. We have some clients on a one-off basis that have already developed Blackline integration. So alongside the monthly push to the GL would be a more aggregator rolled up push, either at the company code or other account level to Blackline's account reconciliation module. They're working on their side to make that a little bit more of an automated approach. Right now it's a flat file push over an FTP site, very similar to how some of you have integration structured. They're working on more of an API approach. That's what, and our product team is working on that with them as well in order to automate that. So we are seeing them in the marketplace a lot more as we are engaging with the controllership at companies. We're certainly excited about it, and in one, from being able to automate some of the entries out of CoStar, but two, to hopefully streamline your month-end close process as well, especially as a result of this reconciliation effort that's going to be required 1/1/19 and forward.